Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market update. So in today's markets, guys, we had some very big news by Federal Reserve Chair Jerome Powell as he made comments on interest rate decisions leading into March, to which the markets reacted very negatively. We were obviously expecting a kick of the can down the road by Jerome Powell, as traders had largely taken the March rate cuts off the table already. However, he was supposed to only slightly kick the can down the road. I'm talking a little gentle tap, but what he did today was pretty much a 50-yard field goal attempt kick, or maybe you could think of something like Cristiano Ronaldo free kick penalty back in his stronger years, 2008, 2009, Manchester United. We're talking a very big kick of the can. So we're going to cover those news, obviously, guys, a little bit of humor because I know it was a very red day. We're going to cover the Fed news, of course. We're going to go over two earnings that I have prepared for you guys in the names of Starbucks, which came out yesterday, and Mastercard, which came out this morning before the open. And then we're going to go through our major technical rundown here, talking about our major indexes, major tech names, and see how everything is doing after today's massive pullback. Keep in mind, today was also the monthly closes, so we'll be shaping up to see exactly how our monthly candles have been affected by today's news, and if we're still looking healthy for the remainder of the quarter and the remainder of the year. So without further ado, guys, let's get right into today's video. So SPY down considerably on the day, 1.63% of the downside. QQQ almost down 2%, and the largest loser of the day was undoubtedly IWM Russell. Obviously, growth names are going to be most affected by any change in policy stance by the Fed because they stand the most to lose, right? These are companies, for the most part, which are unprofitable, running higher amounts of debt. So any pushback in interest rates really takes the lift out of those stocks as a whole. So on the one-day relative performance, guys, you will see that pretty much everything in the market was very negative. We actually started off the day fairly decent. QQQ was pulling back off of the back of Google's earnings yesterday. However, healthcare and financials were faring decently across the morning. However, after your Fed comments, everything ending in the red. And we were kind of expecting this, guys, right? We were leading into today with kind of overbought conditions, not only on SPY, but also on QQQ running a little bit overbought conditions, and with big tech and semiconductors having ran an absolute ton in the past 1 to 3 months. So let's put that in perspective. Even though we had a big one-day relative negative performance here, to kick it back on the 1 month relative, you'll see that most of everything, guys, is still in the green. You do have a couple of outliers, Apple obviously with their negative news, and Tesla to the downside with negative earnings and consistent negative news of price increases. But for the most part, guys, you had some decent gains in the last 1 month. And the last 3 months, ever since our November rally, the gains are really substantial, but we were kind of peaking out. And that's what I wanted to bring your attention to over the course of the week. We were coming into this week, guys, with very high expectations for earnings, but most of your big tech names were coming into the week ever so slightly overbought. And then we were saying that if ever we had some hawkish news by Federal Chair Jerome Powell, then we were obviously going to come down as traders would taper their expectations of further rate cuts for March. And that is exactly what happened over the course of the day. So let's take a look first, guys, at what we are lining up starting the month of February. How is February seasonality said to be? So let's take a look here, guys. February, historically a flat month for stocks. Small caps tend to outperform. Remains to be seen if this is going to be the case, especially with Jerome Powell really kicking the can down the road for those rate decreases. But here are the stats here, guys. Over the last 20 years, February has been a mediocre month for stock market performance. Over that time frame, the S&P 500 has moved higher in 12 of those 20 years for a 60% success rate. So success rate is decent. However, the gains on average, S&P 500 is an average gain of 0.2% in February, which is really low. Compare that to July, which has averaged 2.4% gains during the month over the last 20 years. So February is known to be, guys, a relatively flat month. You can see that on the chart right here. February is usually very cyclical. We tend to get a little bit of an increase over the course of the month of up until the midpoint of February, and then tend to decline. And March is also not known as a very good month for the stock market. It really picks up in April and May. And that would not be surprising considering the timeline that we have before the next rate decrease, which will come most likely at this point in the month of May. So take a look on this chart as well. You can see that seasonality in terms of the month of February. So slight little rally across all of your indexes leading into mid-February, and then a little bit of a decline, guys. So it's very possible that we do get a little bit of monthly continuation, right? But I wouldn't be surprised if that is just to potentially set a lower high on the daily at this point, and then potentially daily downtrend continuation into mid-February, which would really line up with an early February good start, and then potentially taper off into the month of March as well. After such a substantial rally, bulls are still in full control, but eventually we will need to set that monthly higher low across of your major indexes. So what exactly did Jerome Powell do? If you guys weren't listening, I was listening to the meeting. It was a very good meeting up until the reporter asked the question of, will there be March rate cuts or not? And then he really went in on it, guys. So here we go. Fed recap. Powell shoots down March rate cut right here. We don't have a growth mandate. We're going to skip over this one right here, but we're going to go down to these in terms of the notable things that he did say. So just to recap, guys, the early part of the meeting was fairly bullish. We came out with the initial statement here, and then across the board for about 15 minutes past 2:30, the first questions were fairly decent. And the first questions had to do with whether or not the Fed was pleased on the results of inflation coming down. And Jerome Powell actually said that he was very confident in the fact that inflation would persistently come down over the next couple of months, but that they were going to remain data dependent for any rate decreases. And that was to be expected. That's what we were calling for on the channel, for Jerome Powell to really be muted in that respect and kind of kick the can down the road a little bit. Just take, not make many comments on the March rate cuts, just stay data dependent, as he has been saying in the last couple of meetings. And that was really the expectation. But the bad news came in when he really gave an expectation for March and really categorically saying that they hadn't even considered talking about a rate cut in March. So here are your headlines. Fed is looking for signs of inflation that are on a sustainable path down. Upcoming inflation data will dictate how soon the Federal Reserve moves ahead of rate cuts, said Fed Chair Jerome Powell. Obviously, we're trying to get comfortable and gain confidence that inflation is on a sustainable path towards 2%. A lot of reporters commented on your most recent PCE data, which is trending under 2% for the last couple of months. But Jerome Powell said, unfortunately, that there's just not enough data for us yet to be confident in diminishing the rate cycle. However, he did say that we are currently in his best case scenario, which is we are at the peak of the rate cycle. So hikes are pretty much off the table, but it's just going to be a case of staying higher for longer at this point. Now, here's another thing. Powell says a rate cut that the March meeting may be unlikely, and this is exactly what prompted the sell-off right now. Investors have been anticipating a potential rate cut or the beginning of a rate cutting cycle at the March meeting, but Federal Reserve Chair Powell expressed skepticism about that timing Wednesday afternoon. Based on the meeting today, I would tell you that I don't think it's likely the committee will reach a level of confidence by the time of the March meeting to identify March is the time to do that in terms of the rate cuts, he said, but that's to be seen. So still leaving the door a little bit open, but mostly, guys, closing the door in everybody's face as a whole. Once again, Powell says Fed isn't rushing. We had previously forecasted that on the channel as well, that he wouldn't be rushing into the decision. It's still going to remain data dependent. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at that point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So he's pleased in terms of how resilient the jobs market has been, but did make a comment, if ever we were going to head into larger unemployment and a slimmer, in terms of tighter jobs market, right, with less and less jobs being created, a potential uptick in the unemployment rate, well, that will obviously be a catalyst for them to decrease rates a little bit faster here, guys. But as a whole, Jerome Powell really coming in with a hawkish amount of comments here today, and the market was not expecting him to be that hawkish. We were just kind of expecting him to kick the can down the road per se and really just remain data dependent. But the fact that he said that March was off the table pretty much took the last hopes of a rate cut in March off the table for most traders, and now we have to deal with a bit of repricing. So most of your major sectors are now going to reprice to the downside. Keep in mind, guys, in the 1 hour and a half of the end of the trading day, from the end of the meeting with Jerome Powell to the end of trading day, most institutions, guys, do not have the ability to reposition billions and billions, hundreds of billions of dollars, as a matter of fact. That takes some time, which leads me into saying that I do believe that your downfall can potentially continue here, as institutions will have to reprice what they priced in coming out of the month of November. So now we are going to have a little bit more repricing to the downside, which in my opinion could last a couple of weeks, especially with the fact that big tech earnings have not been substantially green for the most part. We still remain to have Apple, Amazon, and Meta tomorrow, but if anything goes sour with those earnings tomorrow, it will just really start off in weekly consolidation for most of your indexes. So really all of your negative catalysts coming together at the same time this week, which is why we were saying this is going to be one of the biggest weeks of the entire year. It's going to set the tone for the year. It's going to be a very good year in my opinion. However, going to be volatile in the next 2-3 months. So the road to recovery is going to be a bumpy path until we get those first lines of rate cuts. So with that being said, guys, let's move in to our first earnings, which is going to be Starbucks. So Starbucks came out yesterday with earnings, as a matter of fact, and they missed. But the share price was up in after hours trading yesterday, as the consensus was, well, it was bad, but it wasn't as bad as people were expecting. Keep in mind, Starbucks had already sandbagged their own earnings last quarter in saying that due to geopolitical events and whatnot, and due to consumer discretionary spending being down, well, that their next quarter, the holiday quarter, wasn't going to be absolutely crazy. So they tapered back the expectations on that. So traders reacting first positively, but today sold off most of all of your gains from the after hours yesterday. After hours yesterday was up about 4.5%. And today erasing everything, guys, almost 6% to the downside, top to bottom, really erasing everything, ending pretty much just below or just at the Tuesday morning open candle right here. So all in all, you know, not very pleased on the report for Starbucks. However, it could be worse, and that's going to be what I'm going for here. Starbucks, in my opinion, guys, at this point, since they are going to go through a transition year in 2024, they're obviously still dealing with economic recovery in China, and a couple things having to do with their PR in terms of the whole Middle East situation right now. Well, Starbucks, in my opinion, guys, really becomes very good value in the mid $80 range. So I won't be buying any more Starbucks unless we really fall to about $86, $85, right? Until we can get some more consistency in their earnings and better forecasts as a whole, because once again, they did decrease their guidance for the upcoming quarter. So let's go over the numbers, guys. Down on EPS ever so slightly, 3.31% of the downside, missed on revenue, and they missed on a lot of things, as a matter of fact. So here we go. Starbucks earnings disappoint as US boycott and cautious China weaken sales. So this boycott is obviously resulting from the conflict between Israel and Palestine. If you didn't know, a lot of people on social media have been potentially wanting to boycott Starbucks because they are saying that they are in support of Israel as opposed to in support of Palestine. So we had a big boycott here back in the month of November and December. And also cautious China, being the fact that China is obviously in a bit of an economic recession right now, and their discretionary spending is down. And we did see that in the numbers right here. So here are the headlines, guys. Global same-store sales increased 5%. However, falling short of the estimates of 7.2%. So the same store sales of 5% is actually lower than Starbucks has been claiming in the past year. 5% is really on the low side, guys. You really want to see these guys growing same store sales anywhere between 7 to 10% is the target number, not only for Starbucks, but any company that is in the food distribution business. You want to see those same store sales grow by 7 to 10%. It's the same thing for McDonald's or any other food distributor like Chipotle that you can possibly think of. So here we go. CEO said on the company's conference call that the chain faced headwinds, including a boycott in the US and increased discounting by rivals in China. The company lowered its full year revenue outlook as a result. So there's the lowering of the outlook as a whole there. So excluding restructuring and costs, Starbucks earned 90 cents per share. That's fine. Net sales rose 8% to 9.43 billion. Same store sales increased 5%, which is a bit on the low end here. Net sales, I'd like to see net sales, guys, increase by over 10% for me to really regain confidence in Starbucks growth story right here. In North America, same store sales also rose 5%, driven largely by customers spending more on their drinks and food. That's fine. But here is the kicker, guys, is the fact that in China, lower ticket sales. China, the company's second largest market, reported same-store sales growth of 10%, which is good. There's your 10% number. However, the average ticket at its Chinese stores fell 9%. That just means that every single person on average that was in there chose to pay about 9% more for the items that they were checking out at. So every customer was buying less things is essentially what this means. The average ticket at its Chinese stores fell 9%. Chinese consumers are more cautious, and that is the big thing here. The chain has seen increased competition from lower priced rivals such as Luckin Coffee, which have won over consumers as China's economic recovery continues to lag. Starbucks executives said the challenges it faced this quarter are transitory, but damaging enough that the company revised its full year sales outlook. For fiscal 2024, the company now anticipates revenue growth of 7 to 10%, down from its prior forecast of 10 to 12. So that's a very decent guide down here, guys. Starbucks also lowered its global same-store sales outlook from a range of 4 to 6% from its previous range of 5 to 7%, 7% obviously being the best, but now we're kind of caught down in a 4 to 6% range. But there is good, guys. The company reiterated its full year forecast of earnings per share growth of 15 to 20%. So at least, even despite all of the negative factors, guys, Starbucks is still growing net earnings. They're growing EPS on the bottom line, which is what you want to see. Now, a couple little things for Starbucks. Starbucks, number one, does have a lot of debt. So it is interest rate sensitive as a whole. And in terms of their free cash flow here, guys, they don't bring in a tremendous amount of free cash flow per quarter. And they also don't have a tremendous amount of cash and cash equivalents to pay down this debt. So they are really beholden to this amount of long-term debt, which in the case of rates today, obviously Starbucks really didn't like that news about rates because of their long-term debt situation. If you take a look here as well, in terms of their free cash flow, you'll see that free cash flow pretty much since 2010, right, has been expanding, but it's not very consistent. Okay, it's really not very consistent. Yes, they're back pretty much to pre-pandemic levels at this point, but it's just not as consistent as a company like the next company we're going to see, like the case of Mastercard. This is consistent free cash flow and additions of free cash flow, right? But Starbucks, unfortunately, just not very consistent on its free cash flow generation, but at least it is consistent in bringing money to the bottom line and increasing earnings per share for investors. So the forecast for the next couple of years is still EPS expansion at about 15 to 20%, and the revenue is still expanding as well at the rate of about, just under 10%. So you'd like to see them get back to 10%, but they'll only be getting back to 10% seemingly in between 2025 and 2026, apparently. So 2024 is still going to be a little bit of a transition year for Starbucks. I do like the valuation down here, but like I said, I'll only be picking up a bit more shares, guys, if we dip down to 85, 86. So really mixed report on Starbucks as a whole, but there are some positives. EPS growth is going to continue to be there, right? Global revenue, 8% up year over year. That's fairly good. And you also have one thing that I did want to bring your attention to here, guys, is this. US card loads reached a record. So this is obviously the money that people can deposit on their app to pay for Starbucks with basically Starbucks dollars from their app. Very, very, very good metric here because this is obviously money that Starbucks can then leverage. It's basically like people depositing money with Starbucks, and then Starbucks can then use that money against potentially to leverage it in terms of depositing money potentially with the Federal Reserve or something like that. So they can generate some interest on this money. And that's a lot of money, guys, in terms of the card loads, right? And also digital, very good digital numbers here. US 34.3 million members, 52% of members are using the digital application in China as well. So these are very good numbers of people pivoting to Starbucks. It just goes to show that the loyalty programs that Starbucks has to offer for its loyal customers are there, and its loyal customer base is not going away. Now for the guidance, once again, well, unfortunately, your comparable growth on a global scale is only going to be about 4 to 6%. Not that great, right? Not that great. We want it to be higher. We need it to be about 7, 8, all the way up to 10% would be the number I'm looking at, right? So your comparative growth of your same-store sales is only going to be 4 to 6%. Global revenue growth is going to be 7 to 10%, but I'd like to see it higher, guys. Need to see this higher on the higher end of 10% here. Operating margin, they'll be progressively expanding it. That's great. Not so much capital expenditures as a whole, and full year EPS is going to be growing still at 15, 20% per year. So all in all, mixed report from Starbucks, guys. Still a recovery story in my opinion at this point, but representing some good value if we do get back into the mid $80 range. Now let's take a look at MasterCard, which is a completely different earnings report, and I'll show you guys why. This company is absolutely bulletproof. Visa and MasterCard, two of my favorite companies in the entire stock market. Their margins are insane. They have an insane moat as well, and their business is just extremely consistent, guys. Really no negative surprises by MasterCard in a very long time, and MasterCard is actually attacking the China market, which it previously has not been into. So let's take a look at their earnings here, right? So earnings, guys, in terms of MasterCard, double beat, not surprising, beat on EPS and beat on revenue as well. MasterCard obviously touching all-time highs right now. Little bit rich in terms of valuation, coming up to about a 40, 38, 39 PE ratio, so slightly high in terms of valuation, obviously close to the all-time highs at this point. I really like MasterCard. If we can pull back here, guys, closer to your previous all-time highs, 420 all the way to 410, I might be looking to add a bit more shares of MasterCard, but there's really nothing negative you can ever say about this company here, guys. Look at your margins down here, right? So on a year-over-year basis, margins Net operating margins, right, are about 46, 45%. Quarter over quarter basis as well, always between 40, mid to low 40% range, which is exactly what you want to see, similar to Visa as well. And their balance sheet is just extremely strong here, guys. Such a strong balance sheet. Look at this free cash flow generation year over year. Here's your quarter over quarter, bring in a tremendous amount of free cash flow. And they do have a tremendous amount of cash and cash equivalents on the balance sheet right now. Company is set up very good. Look at ever expanding EPS here over the next 3 years. Love to see the expansion in EPS, guys, pretty much over 10% at this point, EPS expansion, and EPS, and in terms of revenue expansion as well, just about that 10% mark. So they do respect my 10 and 10 rule, 10% EPS expansion and 10% net revenue expansion. So let's take a look at MasterCard's earnings per se. MasterCard earnings beats estimates even as expenses grow. So very, very good report by MasterCard as a whole. We'll take a look at that in a tiny little bit here, right? So the New York-based company said U.S. consumer spending on the company's cards is continuing to perform well, which helped fourth quarter results. Rival Visa similarly cited strong U.S. spending as a boost to earnings in the period. We delivered strong earnings growth and revenue growth for the full year 2023, driven by healthy consumer spending, cross-border volume growth of 24%, so really getting that international lift, and the solid execution of our strategy. Very, very, very good. And they're starting to come in to China, guys. MasterCard has not been in China because of how regulated the banking system is over there, but now they're starting, which could represent huge upside for them. A joint venture with NetsUnion Clearing Corp was granted a bank card clearing license by the People's Bank in China in November, giving MasterCard a competitive edge over competitors. And here's your CEO. Needless to say, we're thrilled about China. It's a massive economy and we feel well positioned to serve it. So that is going to be extremely, extremely noteworthy over the course of 2024. MasterCard expects net revenue percentage growth in the high end of the low double digits for all of 2024. So that's about, 7, 8, 9% for revenue growth for 2024. Very, very, very good here, guys. And operating expenses are expected to grow in the mid single digits. So as long as they're growing revenue faster than operating expenses, it just means that they're going to bring even more money to the bottom line. So that is exactly what you want to see here, guys. If you take a look, guys, this is really just an amazing year for MasterCard. So take a look here, guys. Right, net revenue in terms of their 2023 fiscal year ending, $25.1 billion. That's an increase of 13% over 2022. Very, very good. They actually had a slight increase in operating expenses, but as long as your revenue is growing faster than your operating expenses, it means that they can bring more money to the bottom line. Operating income was obviously very good as well, up 14%. So bottom line increased there as well. Operating margins also came up about 0.7% as well, which is very, very good. And here's your net income, guys. Your net income for the year was actually amazing. So net income, you take a look here, they did grow at 13%, but let's just get their net operating margin, right? So their net margins here for the company is 11.2 divided by 25.1, 45%, right? 44.6% net margin percentage for the company, which is absolutely insane for the size of MasterCard, for them and Visa to continuously bringing in so much money to the bottom line and then returning that to the shareholders in form of dividends and buybacks is just exactly what you want to see in any given company, guys. It's very, very good. And take a look here as well. We're going to take a look at their gross dollar volume here, increase in gross dollar volume. Look at this massive increase here, guys, on a fourth quarter to comparison of fourth quarter 2022. So very decent increase here in gross dollar volume in terms of worldwide. And that has also come from 4% growth in the United States and the rest of the world outpacing the US, as a matter of fact, really getting more and more of this international market involved. Take a look at your fourth quarter switch transactions and cards. So switch transactions is just the amount, the fees, and any transactions that generate fees on the MasterCard network. So anytime people swipe their card and whatnot, switch transactions, the amount of transactions is up 12% on a year-over-year basis in terms of quarterly outlook, but also the amount of cards is also increasing. So not only do we have more transactions, but we have more members as well. So very, very good here, guys. Nothing bad to say about MasterCard as a whole. You can go through this entire slide. You can go through pretty much their entire balance sheet, which isn't here. It's a bit lower, as a matter of fact. There's literally nothing wrong here, guys. Everything is looking absolutely perfect. No negative surprises whatsoever. So looking forward to see what MasterCard can do with exposure to the Chinese market. This could potentially be very, very big for them in terms of boosting their revenue even more. So that's everything for MasterCard. I would have no problem. This, as a matter of fact, MasterCard and Visa, guys, are two stocks that I could really buy at any given price and hold on to forever and wouldn't even need to think about looking at them. Their moat is so wide. They have such a good customer base at this point. They represent such an integral part of the entire financial markets at this point in terms of transactions and payment processing volume that really there's really nothing that can go wrong with these companies at this point. Such a difficult market to enter for new entrants as well. So MasterCard and Visa really running away with this show at this point, right? So that's pretty much everything that I had for you guys for earnings. Now let's take a look at what exactly is happening with our indexes with this sell-off. So let's take a look at SPY here, guys, right? We're still looking for that daily higher low, but now your short-term bears are in full control, right? Loss of the hourly time frame, hourly downtrend confirmed, loss of your 12 EMA, on the 4-hour time frame. So full bear volume into today. Look at this volume as well. Now, still looking for a daily higher low, anything above pretty much 470, just gonna be looking for a daily higher low. However, guys, in one day, the bears have pulled back over 38.2%, so 40%. If they come down to 480 or potentially even 478, 50% or 60% of the move, it's very possible, guys, that they can set up for a lower high, lower low continuation, which would mean weekly consolidation would be underway at this point. With the amount of repositioning that you're going to see from institutions because of what Jerome Powell said today, the amount of repositioning that's going to come in over the next 1 to 2 weeks, I do believe that today marks the start of weekly consolidation. The confirmation would be the daily downtrend, but I'm going to jump the gun and say we are pretty much going into weekly consolidation at this point as institutions have to reposition. So going to end up here, guys, first line of support, 480 all the way down to about 467, represents a very good portion of your previous all-time high right here. So that should be the first line of defense, and your weekly higher low is 467.54 at this point. So still a decent amount of space for the bulls to pull back here to be able to set the weekly higher low and further trend continuation here, right? But first things first, just need to see how much are the bears going to take back, right? If the bears put in a sizable move right here down into this zone and come all the way, we're going to put the fib on the weekly as well. If your bears come all the way down here into pretty much that same area, 479, 478 area, even on the weekly, guys, you may end up with the potential of a weekly downtrend shaping up, or at least at the best case scenario for the bulls, potential weekly tightening range. So all in all, guys, it is time to potentially play some defense in the portfolios. If you have things that have rallied a ton, it may just be noteworthy to sell some covered calls, because I do believe the month of February and potentially even early March should be fairly choppy for markets after such a beautifully performed November, December, and January. It may just be time for the markets to cool off ever so slightly here, not only on the weekly, but potentially even on our monthly candle close right here. Yes, it was looking very good before today. Today's data really put us into looking like a doji. So would I be opposed to potential monthly consolidation? That would mean daily downtrend, would also mean potential weekly downtrend, and then you would get confirmed monthly consolidation. As a whole, bulls still looking very healthy though, right? Can look for the higher low, anything above 410, just looking for a higher low on SPY at this point. But all that to say, guys, that consolidation would potentially be due for these markets at this point into the month of February and March, because we really didn't have any good things coming out of the Federal Reserve. We're almost through earnings season. Big tech has been overbought, has rallied a ton, and so far their earnings are not living up to expectations. So just maybe a little bit of a time for the market to consolidate. So just prepare for that, prepare the portfolios for it. But as usual, guys, we are still going to be looking for a bullish 2024 as a whole. Second part of the year should be more consistent in terms of your gains. So now is once again, while we potentially embrace this early part and later part of this sell-off that's maybe coming in the next couple of weeks, it's still time to focus on companies that you want at attractive prices and continue to build those positions, because once we're through this time of turmoil right now, the markets are going to be absolutely flying for late 2024, 25, 26, 27, right? Once we get through this hiking cycle and the rates start coming down and the economy really smooths out, it's going to be smooth sailing, and we're on for another 3, 4, 5, 6 years of bull run here, guys. So we're on the last legs. So really, it's really now time to focus in on the companies that you want to DCA in before they potentially start running away from us over the next couple months here, as they ran away from us after the October sell-off here. So I don't think the sell-off is going to be as brutal as the one we got in October, but we're definitely due for a little bit of repricing after Fed Powell's comments. Now, QQQ leading the way to the downside. We were watching out for the daily downtrend, and now daily downtrend is set. So SPY still not with the daily downtrend, but QQQ really running ahead of everybody, setting the daily downtrend here at this point, looking for a weekly consolidation. So daily downtrend at this point, right? If we get a bounce, just looking for a lower high, anything under 428.32, just looking for a lower high for daily downtrend continuation. Now, short-term bears are in full control of your hourly, 4-hour timeframes, and full control of this massive hourly downtrend as well. Right? We're a long ways away, guys, from being oversold on the 4 hours, and even a longer ways away from being oversold on the daily, right? So could just be in for a few more daily downtrend attempts by the bears right here, right? So on the weekly now at this point, 396 is going to be the line in the sand level to watch for the bears right here, right? So the bulls need to stay above here, guys. I'll give you the levels right now so you can put them down on your charts. We need to stay above 412 or at the lowest port, 408.83. If we can stay above those two levels, then it sets the bulls up nicely to just set a weekly higher low, potentially just resume the weekly uptrend to the upside. Take too much of the move back here in the next couple of weeks, could be setting up for a lower high, and then best case would be a tightening range at the top. But the worst case could be a weekly downtrend here into monthly consolidation over the course of the month of February and potentially even early March, right? On a monthly relative basis, monthly bulls full control. So we're only looking for monthly lower high. If we get a negative February, negative March, looking for a lower high, or excuse me, higher low for further trend continuation over the next, over the second half of the year. At that point, April, May, June should be very good months for the market. Just maybe due for a little bit of a pullback. So that's why I say, guys, right, the next dip buying opportunity may be one of the last dip buying opportunities before we really start exploding past these all-time highs here in, later part of Q2, Q3, and Q4. Now moving on to financials. So financials, guys, like we were saying, right? Financials and healthcare needed to hold the ball up today if QQQ were to drop, and they did that early morning. However, when Fed Powell came out, really everything started to drop at the same time. So it has to be notable to us. And financials will get some repricing to the downside because they are sensitive to interest rates. So I am expecting further consolidation, on financials right here. Any dip at this point, just looking for a daily higher low, anything above $37, looking for a daily higher low for potential further trend continuation. But if I had to bet my money on it, guys, maybe just due for an extended pullback, which could set up for a daily downtrend. I'm going to be targeting this area on the weekly right here. We're talking about 37, pretty much all the way down to about 35.50 is going to be the range to be maintained here. Still in a very healthy weekly uptrend, but getting a little bit toppish, guys. Toppish on the weekly RSI. We noted that we were getting a little bit top heavy on the daily RSI yesterday as well. And financials have just had such an insane rally here, guys, since November. We're talking, as of yesterday, almost 26% to the upside. Could just be due for a little daily consolidation, even weekly consolidation at that point, guys, right? We're going to need to protect this weekly low. 37 is going to be the mark to protect for the weekly higher low for further trend continuation. But if ever we end up in a weekly downtrend, well, it's just going to be monthly consolidation. And then monthly consolidation, we should be able to protect this range right here, 37 down to about 36, this green box. Going to be looking for potential monthly higher low for further trend continuation. So long-term bulls are all still in control here, guys, but I think it may be time for some extended consolidation, cool down these dailies, cool down these weeklies on pretty much everything at this point, right? QQQ started already, right? But it may just be time, a little bit of a cool off cycle. Now moving into healthcare. Healthcare, same thing, was healthy on the morning, but got really dropped hard after Jerome Powell's comments here. So healthcare, contrary to the rest, they actually had recaptured the daily uptrend right here. So still currently in a daily uptrend reversal attempt, right? Just looking for a daily higher low, anything above 137.23. Looking for the daily higher low for further trend continuation at this point. But if we take back too much of the move, could be setting up lower high, lower low into daily downtrend, which would just mean further weekly consolidation here at the top. Could be a very good weekly bull flag pattern right here at the top of the move. We're very close to the previous all-time highs as well. So if ever we do get daily consolidation into daily downtrend, weekly consolidation, weekly bull flag. This is just looking, guys, for a monthly higher low, and keep an eye on this level, right? This is why this green box is so important. It's the higher time frame support. So 136, all the way up to about 137, down to about 133.50-ish. That's going to be the area where I do think that healthcare can pull back into, and the bulls are going to be acting as very solid support down there. So let's just keep an eye on that. As of now, bulls haven't lost anything. Let's just see how it goes over the next couple of days. But I am expecting longer form pullback on a lot of these things, guys. We've had a tremendous rally. Just to reiterate, may just be time to cool it off a little bit as institutions reprice expectations for the first half of the year. Now, IWM Russell losing obviously more than most here today, 2.5%, interest rate sensitive sector, so no surprise there. So now we had the daily uptrend a couple days ago, but I said Jerome Powell is hawkish. We could reverse this in an instant, and that's exactly what happened. So now, unfortunately, daily downtrend is now in motion by the bears. New daily downtrend means that we're into further weekly consolidation, and here's the problem with IWM Russell, right? We were looking for the weekly higher low for further trend continuation, but once again getting rejected at our previous 2 years of rejecting of resistance at this time, right? So now the key level to protect 187.65. It's a very key level because if we lose that, it would be a weekly downtrend. So what I'd like to see is bulls protect that level, potentially set up for a bit of sideways consolidation, maintain a tightening range, right? Don't want to see these lows get crushed. If these lows get crushed in the next couple of weeks, keep in mind my buying term area is 187 down to about 180, could represent a good buying opportunity. If we get the weekly downtrend here, guys, it's into monthly consolidation, and the monthly candle close on the Russell wasn't the best, right? Still unable to close above on the monthly above our previous resistance area. So could just be looking for a bit of a monthly higher low here coming into February for potential trend expansion once rates do start coming down, or once at least we start getting a bit more positive sentiment out of the Fed here. So keep in mind, Jerome Powell in the March meeting may not be commenting, may not be decreasing rates at this point, but after that, the markets do believe he really doesn't have a choice here, guys, right? So there's only a couple CPI reports before the March meeting, CPI, PCE, and we will have a lot of jobs data coming out as well. So the consensus is that this was the last meeting that he can kick the can down the road. In March, he will most likely have to address the next meeting after that, which is May, as the potential end of this rate hike cycle and start the rate decrease cycle as of May. So this is the last meeting that we were expecting Jerome Powell to be to be bearish. So very possible that your Russell stocks are going to be bottoming out here for the last time, for potentially a very nice recovery into the second part of the year. And now lastly, our Dow Jones. Dow Jones, I apologize not covering it yesterday here, guys, but on the course of the day here today, daily uptrend continues to be confirmed, looking for a daily higher low, anything above 37,800. Just gonna be looking for a daily higher low, right, for further trend continuation. But if the bears take back too much of the move with the repricing over the next couple of days, guys, could get a daily downtrend or just flush like this and maybe into daily downtrend. If we do get a daily downtrend at this point here, guys, just look for weekly consolidation. Anything pretty much above 37,100 is going to be for a weekly higher low for further trend continuation. But the bears take back too much of the move over February, we get a weekly downtrend. Well, may just be due for monthly consolidation on the Dow Jones as well. Monthly uptrend is very healthy on the Dow Jones. So after 3 months of a beautiful rally, eclipsing your all-time highs, could it just be time now to come back, sit on your all-time highs over the month of February and early March, and then rally into the remainder of the year? Very possible scenario, and I would say very highly likely scenario, because the markets at this point, guys, we don't have many bullish catalysts to rally on currently for the months of February and March until that March meeting with the Fed, right? So it could just be a time for markets to consolidate, cool off the gains that we've had over the past couple of months, and that's how we will be playing. I will personally be playing it in my portfolio as well, but just please remember that the bulls control all of your monthly time frames on absolutely everything. We're just looking for good, consistent pullbacks here and should represent one of the last buying opportunities, in my opinion, for the remainder of the year before the real start to the bull market, which is going to come when rates come down. So just keep that in mind, guys. Bulls still control of the higher time frames, but daily and weekly just may be in for a little bit of consolidation. Now, look at yields, however, and this is the kicker. This is the key factor, guys. It is in the yields, because even though Jerome Powell gave a fairly hard kick to the can today, well, yields came down substantially. So take a look at this, guys. We had a daily uptrend going. They lost that daily uptrend over the course of the early week, and now weekly higher low is set. Resistance of the moving averages right now, so looking to just perpetuate this weekly downtrend. And the hint is here in the yields, guys. So the 20-year, the 10-year is coming down over the course of the day aggressively as well. And this is how you know that today's meeting, guys, even though he came out hawkish, even though it was a slightly bearish tone, The moral of the story is that the rate increases are done, and we are going to decrease rates over the course of this year. And bond traders absolutely, ran with it over the course of the day today. These yields, as I've been saying, guys, should not be above 4%, considering that we're about to embark on a rate decrease cycle here, which is going to last pretty much through 2024 and 2025. There's no reason that these longer term yields should be this high, as a matter of fact. And traders reacting beautifully to that today, pretty much calling the bluff on yields as they should. So this is going to be a very good trade in terms of yields continuing to decrease over the course of the year. And as soon as we get that first rate cut here, guys, these should be starting to decline at a much faster rate, which is going to give some very good lift to your bonds as a whole. So very decent drop on yields over the course of the day. Equities didn't like it because they ran a little bit too much from November in anticipation of the rate decreases, but yields absolutely loved his comments over the fact that we had really reached interest rate cycle peak and that the rates cuts were coming over the course of the year, just maybe not as soon as March. So these things continue to come down. And while these continue to come down, guys, it is giving the underlying tone to the market of being bullish. So just keep watching that relationship between the yields and your equities. Now let's move on to big tech. So guys, going to go through big tech fairly quickly because a lot of them have earnings tomorrow. So Apple coming down once again. Bears now, the bulls were in control of this daily uptrend. Size of the bounce was very juicy, but now bears taking back too much. As soon as you see this, guys, red lights should be flashing in your mind when you see an engulfing move like this by the bears. At this point, the bears have taken back almost 78% of the move, which leaves the bulls with two possible scenarios. Best case scenario with earnings tomorrow is lower high and then potentially tightening range, right? For them to recapture all of this in earnings tomorrow, that would be about a 6% move. Apple usually doesn't move that much after earnings up or down. So that would be a heck of a move to just V-shape this. But Apple, I'm not very bullish on Apple here, guys. Number one, they've had a lot of negative news coming over the past month. And number two, their iPhone sales potentially are going to have a guide down. And Apple already warned that this year was going to be a little bit of a flat revenue year in relation to 2023. So not expecting very much revenue growth on the case of Apple over the course of this year. We'll see how they do on EPS. We'll see how they do on net margins as well. But I'm not expecting this to be a record quarter for Apple. I'm not expecting a huge surprise to the upside. I think it's going to be a tale of more caution to come ahead. And that I don't believe is going to be well perceived by the markets. I could be wrong. We could have an outstanding quarter, but all the data released over the past month and a half points to the fact that Apple right now is just going through a transition phase, and it may just be a difficult quarter in terms of the reporting for them. Excuse me. So with that being said here, guys, right, need to watch out for the engulfing move by the bears at this point. If they truly engulf this move and set up for the daily downtrend, well, just be further weekly consolidation. But if we lose these lows, if you lose 180.30 tomorrow after earnings, right? Keep in mind, Apple, Amazon, Meta, earnings tomorrow. If we lose this, well, weekly downtrend will be started here, guys, and then we'll just be in monthly consolidation. We'll be looking for a monthly higher low, anything above 166 at this point. So still have a good opportunity at protecting this monthly tightening range. The one thing you wouldn't want to see is a break of 166, because then we'd end up in a monthly downtrend at that point, which would, those things take some time to reverse, guys. When you end up in a monthly downtrend, it usually takes a long time to come out of it in terms of a trend reversal. So just keep a close eye on that for Apple. Apple, if we do come down, as I've been saying, if we do come down, I still like Apple. But at this point, guys, I'm going to be looking for the mid 170 range on Apple. If I can get 175 all the way down to 165, that's going to be my target range for the company. So limited price action that we can talk about today. We'll see how they do after earnings tomorrow. Now, moving on to AMD. AMD pulling back here today, once again after earnings, 2.54% to the downside, but reacting nicely from your previous area of all-time highs. So we were saying that if the bears were to take a stab at this and come down, we were looking at previous all-time highs to act as some support, and they did. 157 to about 164 was the level. You can see we pulled right into that zone here today, and the bulls putting up a little bit of a fight. But losing the daily uptrend ever so slightly, right? The higher low was anything above 164.61. We actually lost that here today, guys. So very possible that with a 100% engulfing move, we just set a lower high into potential daily downtrend, and that would just mean weekly consolidation at that point. Anything above 134.09 would just be looking for a weekly higher low for further trend continuation, guys. But AMD as well, looking a bit top heavy. Currently, weekly is still overbought. We'll see what they have to, we'll see how investors react to their earnings that they just had a couple days ago. But I covered it yesterday, guys. And earnings, they weren't the best. I'll be quite frank with you. They just were not the best. And as I was saying, guys, most of this lift was only due to price to earnings multiple expansion. It means that the price of the stock increased without the underlying fundamentals of the business increasing, right? So usually the stock price increases comes from two things. It either comes from only an increase in price, or it comes from an increase of price as a result of earnings. And this was literally only increase in price due to speculation. Their underlying earnings have still not gathered the amount that they should be required here to maintain this current share price. Unlike NVIDIA, NVIDIA really has done a good job of expanding their earnings. They're realizing that revenue from their data center warehousing capacity. AMD still not yet to expand the revenue from that line of business at exponential levels like NVIDIA has. So a little bit overvalued currently, AMD, in my opinion, especially after yesterday's earnings call. So we'll see how they do, but looking very likely that we may get a daily downtrend reversal here, cooling off your weekly time frame as well. The monthly is still looking very healthy, though. Monthly uptrend is well in motion. So even if we end up cooling off the weekly a lot, well, anything on the monthly, anything above 93, guys, just looking for a monthly higher low for further trend continuation at this point. But AMD, I'm going to be waiting personally here, guys. I would really start averaging into this company. I know it's going to sound low, but if we get below 140 again, that's where I'm going to be potentially taking a further stab at AMD shares. Now moving on to Amazon. Amazon limited price action, guys. They do have earnings tomorrow after the close, so we'll see how they do. But as a whole, down 2.39% to the downside here today, looking to protect this higher low daily uptrend potential, right? Anything above 150, just looking to set the daily higher low for further trend continuation. It's all going to rely on earnings here, guys, today. If they post terrible earnings or earnings that are just coming in line and potentially softer guidance, we may end up with a Google. If we end up with a Google and they flush this, well, opportunity is there for the bears to set the daily downtrend in motion at that point. If we do miss on earnings here today, well, unfortunately, guys, going to be in weekly consolidation here. Anything above 145.06, just going to be looking for a weekly higher low. So the bull's still working with a lot of space, but earnings are going to be crucial and obviously targets to the upside. We've mentioned that before. If Amazon really crushes it, we're going to pretty much 165, 170 to the upside here. But wouldn't be surprised if we get some downside, guys. If we do end up in the range of 148 all the way down to about 140, this is where I want to be picking up Amazon personally. Obviously, the lower the better, right? All the way down to about 140. On the monthly, everything looking healthy for Amazon. However, right, monthly uptrend is well in motion. So even if we do get a little bit of a pullback here on the daily, set the daily downtrend, set a few red weeks in motion here in terms of the weekly, well, we're just going to be looking for a monthly higher low over the course of maybe February and early March. Monthly higher low for further trend expansion here into the later part of 2024. So Amazon looking very good, just waiting for that pullback personally. Now moving on to Google. Google just, very negative day after earnings, right? Their earnings weren't even that bad in terms of the numbers personally, as we went over yesterday, but the market just reacting very negatively to them. Almost 100% retracement of this daily move higher. So we were in a beautiful daily uptrend at this point, but now the bears have taken back so much of the move that the likely scenario is lower high when we do get a bounce and lower low continuation, right? So the bounce will only come in, as I was saying with Tesla, right? Need to watch for the hourly trend reversal. As long as we can't reverse this to the bulls, well, your daily move down just continues at that point, approaching a very big area of resistance area of support on the weekly time frame is about 140 all the way down to about 138, quickly approaching that zone, but should be playing as some very good support for the bulls. At this point, guys, anything above 136.72, still looking for a weekly higher low, but the amount of the move that the bears have taken back, guys, almost taking back 75% of the move. So even on the weekly, guys, the best case scenario for the bulls is a tightening range at this point. Even on the weekly, such a violent pullback, just maybe expecting a bit of a tightening range. Look, when we had an engulfing move here after their earnings in October, it took us a while, right? Tightening range, and then you got the breakout. So it may just be due for a little bit of a tightening range here. Worst case scenario is obviously the weekly downtrend, either or, just going to be looking for monthly consolidation. Look at this monthly candle close on Google. Not very bullish, is it, right? After eclipsing the all-time highs, really lost everything in the last 2 days of trading of the month. So this candle could have closed very bullish, but instead having a fairly bearish tone to it, right? Still looking for monthly trend continuation at this point, but the daily fails, get a daily downtrend. If your weekly fails as well, get maybe even a weekly downtrend or a weekly tightening range. That's just going to be monthly consolidation here. Anything above 121.48, just looking for a monthly higher low for further trend continuation. So looking good, long-term bulls in control, but short-term may be dicey here for the markets, guys. Meta also can't say too much. They do have earnings after the close here tomorrow, so we'll see how they do. But as a whole, Meta holding up, 2.48% to the downside, but they still have a lot of space here, guys. So daily uptrend is in motion. Still just looking for a daily higher low. Anything above 358, going to be looking for that daily higher low. Same concept. If we go higher, well, obviously Meta is at current all-time highs. So we're going to have to get above your $400 psychological level. Then 450 becomes your next area of resistance. But if for whatever which reason Meta is underwhelming and we start challenging these daily higher lows, well, that just may set up the doors for the daily downtrend, similar to the other stocks. Weekly consolidation as well. At this point on the weekly, anything above 337, just for weekly consolidation as well. So bulls still looking healthy on Meta, but weekly, slightly overbought. Meta's had a tremendous rally. Daily, obviously still overbought, even though we had a drop here today. On the monthly, though, everything looking very healthy on the monthly for Meta. So even if we do get extended pullback over the month of February and potentially early March, still just looking for a monthly higher low, anything above 277, monthly higher low for further trend continuation on the later part of 2024. So Meta, same thing, looking fairly good on longer term timeframes, but we'll see what happens with the short ones tomorrow after earnings. Now, Microsoft pulling back 2.69%. They had earnings yesterday. So on the morning, they did actually set here, guys, right? At the open, they set a new all-time high, regular market hours, and then pulling back. So Microsoft pulling back significantly, still looking to protect the daily uptrend here, right? The mark is going to be 385, anything above 385, just looking for a daily higher low for further trend continuation. The bears, however, taking back 61.8% of the move. So it's very possible, guys, that at this point we get lower high and lower low set in terms of the daily downtrend here. If that happens, then obviously we're into weekly consolidation. In my opinion, we're going to start weekly consolidation on most of these, but just to respect the technical structure here, need to wait for the daily downtrend to be in motion to fully call for weekly consolidation. At this point, guys, on the weekly, anything above 365, just looking for a weekly higher low for further trend continuation. Very nice area of support, guys. 384 is going to come in, and then obviously your 377 to 360 range has been a big one in the past. On the monthly, everything's looking very healthy for Microsoft. Monthly uptrend just confirmed at this point. So if February is a red month and early March, just looking for a monthly higher low, anything above 309, just for a monthly higher low for further trend continuation. But have been overbought in the weekly now from Microsoft for a bit of a while now, and daily overbought as well. So might just be due for some time of consolidation. Now Netflix, guys, same principle, right? So Netflix, actually green, one of your only green plays on the day here today, but same concept. If we do get a pullback in most of the rest of major tech, Netflix will not be immune. So just looking at this point for daily consolidation, anything pretty much above 477, looking for a daily higher low for further trend continuation. Watch the size of the pullback. If the rest of the market continues to pull back, watch the size of the pullback on Netflix. They need to only pull back. The best case scenario is pull back only as much as 539, and then set the daily higher low and then continue to the upside, right? As if we get the hourly trend change back to the bulls at 38.2% of roughly $540, that means that your bulls are set up nicely to just continue this daily downtrend. But if we pull back here, guys, 50%, 61.8% of the move, well, you could just be opening the doors here, guys, for some potential daily downtrends opening into potential weekly consolidation on Netflix. Anything above 462, just going to be healthy weekly consolidation on Netflix. You can see this area was big chop zone for Netflix, not able to close above at the end of this week. So may just still be acting as resistance, guys. This 575 level was a very nasty level for pretty much a year of time back in 2020 and 2021. So weekly, still looking good, tons of space. Monthly, however, as well, still looking good, tons of space here. Monthly uptrend, very nicely in motion here, guys, right? So even if we do pull back for a next couple of weeks, just looking for a monthly higher low, anything pretty much above 344, monthly higher low for further trend continuation. I don't think, guys, we're going to really break down below this $500 level over the course of February and March. I think now that we're in this channel, the bulls are going to protect this channel here above 500 and really start moving towards the higher end of that once we get the bullish cycle reversal back into end of February, maybe early March. Now, looking at NVIDIA here. So NVIDIA, right? Not that bad of a day, but not good. 1.99% to the downside. So you can see here, guys, right? Hourly trend change trying to get had by the bears here at this point. So we'll see if their daily trend, if their daily higher low continues to be put in right now. Anything pretty much above 473, just looking for a daily higher low for potential further trend continuation. NVIDIA not with earnings here for a considerable amount of time, still about 3 weeks away on that. So we're still just looking for a daily higher low. Daily still overbought, but trending ever so slightly down now at this point, right? So just keep an eye, guys, on the size of the pullback when it starts happening. You want it to pull back to roughly about the 570 range before regaining the hourly trend change to give yourself the best chance of resetting that. But if we, for some reason, come too low, set the daily downtrend, guys, well, weekly bulls are in full control here, right? Anything pretty much above 474, just going to be looking for a weekly higher low for further trend continuation here. Going to be very tough for NVIDIA to do it on its own. If the rest of the market pulls back, I do believe that NVIDIA should be pulling back as well. And the monthly close, it looks absolutely gorgeous here, guys. Monthly close is beautiful. Long-term bulls are in full control. So if we get a couple months of pullback as we did in September and October, I do believe it's just a buying opportunity for the best, for very good continuation here, end of 2024. Now our three last ones. Tesla, 2.24% to the downside here today. And we are just going to continue at this point, your daily move lower, right? So we were looking, daily downtrend was confirmed. Size of the bounce was crucial. The bounce size was very weak before the bears recaptured this hourly trend to the downside. And now the bulls put in some work today, but shut down end of day. So if the hourly downtrend continues into tomorrow here, guys, most likely we are going for lower low continuation. Just continuing on this daily downtrend cycle right here. Going to keep an eye. 180.73 is your low. Flush that, we break once again to the downside here, and we're going to be approaching the lower end of the channel. We're talking about 176, 175 area should be a decent area for Tesla to really find some more support in. It's also a very decent area of confluence on the weekly. You can see it best here, right? So 180 all the way down to about 167 is going to be the area to watch. Horizontal area of support. Downtrending channel line is also right down there as well, right? And the valuation does become quite attractive here. If we trend lower into even the 160 range, it really becomes attractive. Tesla's car business on its own is valued at about $140, $145 a share, plus all the extra things that they do. So we're really coming down into fair value territory. But as of now, bears still in full control. Now moving on to, and on the weekly as well, right? Weekly, just massive weekly downtrend just continues, right? They had the weekly uptrend at this point, but now loss of the weekly uptrend should most likely result in a lower high at this point. Then we're going to measure the size of the bounce to see if the bulls can turn this around. Monthly, not looking the best, guys. Monthly downtrend on Tesla. So as long as interest rates remain high at this point, I think Tesla's recovery is still not going to happen for the foreseeable future. Talking maybe the next 2-3 months. I know it sucks to say out loud, but that's just the reality of the business that Tesla is in. Now moving on to Palantir, guys. So Palantir, very weak day on Palantir as well. They were up as high as about 1674 and pulling back here today, almost 4%. Daily downtrend now set by the bears, right? So we were looking to protect these lows, to give the bulls another shot at maintaining this daily uptrend. Nope. Daily downtrend is set. Earnings next Monday, so not that many trading days before earnings here, guys. And I do personally believe myself that we're going to have to protect this 15 to about 1450 level, right? So daily downtrend is back to the bears at this point, which means your weekly higher low is set. So weekly downtrend looking to be perpetuated at this point. Break of 1566 will just mean another weekly leg down at this point, and just means that further monthly consolidation is underway. Target the lower end of this monthly consolidation, which is really your 1550 down to 14. As close as possible to $14 as I can get is where I'm going to be averaging on Palantir, but not looking the best. But still limited price action before your earnings. I don't believe, guys, that we break down much below 1550 before your earnings. Only a couple of trading days left for that on Palantir. So really earnings can turn this around for the stock, or is just going to extend daily and weekly consolidation into our lower levels. And then lastly, PayPal. PayPal, guys, started off decent, but highly sensitive to interest rates. Look at this drop after Jerome Powell, the initial comments of the meeting, and then flush to the lows here, 61.19 on the day. So PayPal, just as I was saying, has earnings next Wednesday. Going to be tough for them to break out of this pattern much before Wednesday. Now, we were looking for the tightening range, and that's exactly what we're going. Need to protect 59.05, pretty much this low right here. Maintain this tightening range into earnings, and then it's going to be up to the CEO and the comments pretty much that are made in terms of guidance for EPS and margins to really give this company some lift. They're going to be highly dependent on their the front and center things for this earnings, guys, is going to be guidance in terms of cost reductions and efficiency, improvement in margins and free cash flow. And the focus of the current quarter is going to be the same. It's all going to be about EPS, net margins, and free cash flow. Those three things have been fairly flat for PayPal over the last couple of years. Even though revenue has been increasing, they've had difficulty bringing up their bottom line and increasing free cash flow from quarter to quarter. So that's what's going to be front and center for PayPal. But now just doing one of these consolidation ranges after this nice move up, bears took too much of the move back. And now you see what I mean when I say consolidation range after a heavy pullback by the bears. You can apply this same situation to exactly what happened on a lot of things, such as where Google might go and a lot of other names as well, right? So just keep an eye for those tightening ranges. So PayPal really can't lose this. I wouldn't like to see them lose that $59 mark much before earnings. Earnings can send this either way, guys. We're either going to close above this downtrending channel line that we've been stuck in for a better part of the last 2 years, or we're going to start revisiting some of your lower levels where the valuation gets even more attractive. Talking about big support, 60 all the way down to roughly 67. 57 is the area to watch coming after earnings. So that's everything I had for you guys today. We're going to wrap it up tomorrow with our major tech earnings here, Apple, Amazon, and Meta. So just stay poised. I hope I didn't come off too bearish in the video. That was not the intention. I am still long-term bullish on most of these companies that we cover and all of your indexes as well. It's just we may be in for a period of consolidation as institutions rebalance after Fed Powell's comments today. So just keep that in mind. Still looking for attractive stocks to buy at attractive levels. Just let the markets come to you. After such a substantial rally, we may get some of these great stocks back in the levels that we want. So as always, guys, hope you enjoyed the video. Consider dropping a like if you did. Consider subscribing to the channel if you're new. And as always, if you have any questions, please leave them down below in the comments. Take care. See you tomorrow. Peace.